And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. What do you do in a downtrending market but still want to stay invested? When traders are confused on the fundamentals and technicals, and they are confused now, they often turn to momentum investing. Let's talk to someone using baskets of ETFs to do just that. Meb Faber is CIO of Cambria Funds and runs the Cambria Global Momentum ETF. That's GMOM, an actively managed fund that selects approximately 17 ETFs across several asset classes based on price momentum. Also joining us here, my old friend at the NYSE with me, Tom Lydon from ETF Trends, just back from his successful ETF conference in Miami Beach. Meb, thanks for joining us. Your Global Momentum ETF, it's one of the big winners in the ETF space this year, up 6%, S&P's down 14%. Tell us how this works. What does it own, and how often do you rebalance?
Well, this fund doesn't mind being different, and as Tom Lydon, our fellow panelist, knows, I have no problem embarrassing myself. We've sung karaoke together. So this fund is meant to be an outlier in a world of funds that kind of do the same thing. So it can go anywhere. It can do anything. It's a trend-following fund, so it looks for two things. One, what's been going up? That sounds simple enough, right? Over the past year or so, intermediate-term momentum. It looks at the global opportunity set, so stocks, bonds, real estate, commodities, everything. But the key criteria is it has to be in an uptrend. And long-term trend following, something like the 200-day moving average, which has been around for 100 years, right? So those two combinations sometimes can put you in a normal portfolio. In times like now, it's a big outlier. It's a lot of real assets, a lot of commodities, some residential real estate, some utilities mixed in, but a portfolio that for this environment is unique. It's been a while since we've had this inflation, rising inflation. Typically, that is not a warm and fuzzy place for U.S. stocks or stocks in general. So it's saying right now you want to be a little more in the real asset spectrum, which most investors, when we poll them on Twitter, have no exposure to.
Yeah. I want to distinguish between trend following and buying the dips. There's a very important distinction. I want you to make that. And I know, Meb, you did a very famous 2007 white paper on this, but make that distinction for us.
So, there's two pillars or foundation which we build portfolios. One is value. So we find value in all sorts of weird, funky places. And the other is trend. Sometimes those are sort of a yin-yang diversifiers. They look very different, like today, right? So most assets are in a downtrend today. U.S. stocks, foreign stocks, most real estate, bonds even. That's pretty rare, where kind of everything's going down. Commodities and real assets really the only thing going up. Now, my favorite investment is when value and trend overlap, right? A cheap investment that's in an uptrend and is also usually hated. That's not the case right now, particularly with most assets in the world going down. So really, the last place to kind of hang out is in many of these real assets, and particularly the commodity patch.
Yeah. So, Tom, this seems like a very good moment here for trend following overall, right? People are confused on the fundamentals. They're confused on the technicals. So just stay with whatever is working, I guess, is the right thing to do. That's the nature of trend following, right?
Well, you're exactly right, Bob. And really what Meb's pointing out is we have a moment in time that we haven't seen for a long period. And you relate that to ETFs. Coming out of the financial crisis, we only had 1/10 of the money in ETFs that we have today. And back to Meb's paper, he wrote it in 2007. Nobody read it. But in 2009, after we had this big decline, he had 300,000 downloads after the fact. It really brings up something that's important. Technical analysis and trend following can do an important thing for investors. It can remove emotions. If you have a technical strategy and you stick to it, you don't have to stick through these very painful days or trends like this because you have a specific plan. And we know, even though a lot of people buy and hold and do asset allocation, there are a lot of folks, especially financial advisors, that use trend following.
But so let's just go back to this whole point about, I don't want to drag in Eugene Fama and factors, but for decades it's been known, Meb was mentioning value. Value is a bit of an outperformer long-term, although hasn't been recently. And so is momentum, even to a certain extent. Quality is another aspect. There's all of these, a small group of factors that seem to do better than the market over long periods of time. Is there an ideal allocation for trend following? Meb, for you too, if you want to chime in, but I mean, what do you do here?
I think, Bob, you're hitting on something key. And Meb, jump in here, but as we talk about the commodities area, we talk about inflation, we talk about declining rates, and people historically said, well, it's good to have 3 to 5% in gold. Well, gold isn't doing it for us in the commodity space right now,
right.
Number one. And number two, a 5% allocation isn't going to help your portfolio if we continue to see higher rates and we see higher inflation. Meb?
Yeah, so if you look at the long history of trend following, I mean, again, this goes back 100 years, back to the time of Charles Dow. Trend following is probably the ultimate diversifier to a traditional portfolio because usually it does well when everything else is hitting the fan. And this is really a key point. Like buy and hold is a fantastic investing strategy. I love buy and hold. The problem with buy and hold is that it often does poorly when everything else is doing poorly, not only in your portfolio, but in your personal life. Recessions, inflation at 8%, huge unemployment spiking up, on and on and on. And so trend following, we say, and we're the big outlier here. I don't know any investment advisor in the country that puts as much as trend following strategies as we do. Our dedicated allocation, we call it Trinity portfolios, is half in trend following. And it's funny because you read a lot of the academic literature and the optimizers, going back to what Bob was talking about with French Fama and the academics. And even the big banks, they'll often run these optimizations and they'll say, okay, we're going to be blind. We're going to allocate to all these asset classes and let the optimizer decide. And they always say you should put like almost most or all your money in trend following, but then they always conclude, okay, we can't do that because that's crazy. So we're going to max it out at like 20% or something, right? So it's like kind of not a very honest realization.
Yeah.
But the problem with trend is it also is hard to follow, like buy and hold, but it's because you look different. So for a lot of the period post-financial crisis, trend's been kind of totally average.
Right.
You know, when S&P is going up 20% a year, it's hard to follow. It's usually, particularly during crisis periods, when it really starts to shine.
Now, you rebalance monthly, is that right?
Mm-hmm. Yep.
Okay. Is there any sign this will be different a month from now? I mean, I know I'm trying to force you to say something you can't say, but this doesn't give you a crystal ball into what the next rotation is going to look like. You're loaded up on commodities right now. Does that mean next month you might be loaded up on consumer staples or something like that?
Could be. You know, this month we made a couple changes, not a lot. We bought some utilities. We sold a couple of the value funds, stock funds, remaining stock funds we had. But in general, you know, if you look at across the board on what it owns, like it's not a traditional happy place, risk on type of traditional environment we've seen from normal portfolios. So, you know, some of the assets are closer to downtrends than others. But usually what happens is it moves in pieces, right? You'll see a chunk of the portfolio come out and another chunk. Very rarely is it like a full scale moves from, you know, a huge allocation to nothing. Typically the time frame we're operating on is full cycle. So this is playing out over the course of quarters and years rather than days and weeks and months.
So speaking of trend following, you're good at following this. What are ETF flows telling us? Well, first off, do you think ETF flows are a good trend indicator for anything?
They're great.
Sometimes I get confused by them because, frankly, sometimes I don't think they tell us much of anything, and sometimes it seems rather significant. Enlighten us.
Flows can be emotionally driven. We know that. The stock market can get emotional. At the same time, I think the key thing here, Bob, is most money is managed by people, either advisors or people who have a lot of money. People who have a lot of money tend to be older. You and I talked about this earlier.
Why are you looking at me?
If we're a little bit longer in the tooth, we've got more of an allocation.
Now you're really annoying me. You're pointing to me and you're saying long in the tooth. We're both boomers. So
very
sensitive about this.
And with that in mind, you have more of a balance, maybe a 60-40 portfolio. You talk to advisors, they're not concerned about the volatility in the equity markets as they are as far as rising interest rates and what inflation's going to do. And you look at that fixed income portion, if your client is close to retired or retired right now, the outlook for fixed income is pretty bleak.
Yeah, but I want to go back to the question.
Yeah.
I want to talk about this outlook in a little bit, but the trend right now, what are we seeing in terms of flows?
A couple of things. We have more money going into commodity-based ETFs than we do in U.S. fixed income ETFs here today. That alone is crazy.
They're following Meb around. That's what they're doing.
They are. And then also, as far as what little inflows we're seeing on the equity side, we're seeing huge outflows in the S&P 500 like ETFs. And why is that? it's because they're jacked up on FANG stocks or Microsoft or Tesla that are doing so poorly compared to the major index. And if you went into like an equal weight, RSP, that Invesco equal weight ETF, just today, for the first time, it went down double digits. It's only been down single digits so far year to date. Because the broad market...
You're talking about flows.
We're talking about performance, but also flows are down a little bit. Most of the outflows on the equity side are coming out of the S&P 500.
And bond funds, though, since the beginning of the year.
Bond funds, very, very small. It's net positive, but it's less than $20 billion.
This amazes me. You know, at your conference, I mean, people were saying 70-30 or 80-20 is the new 60-40, and we're still not seeing big outflows.
No, but
in bond funds.
There's a record amount in cash in money market funds, record amount in short duration. People are taking their marbles and they're going elsewhere.
Okay, I want to talk about that a little bit later. But just speaking of flows, Kathy Wood's ARK Fund, I did an interview at your conference with Kathy Wood, and she marveled at the fact that she has a very loyal following, and it's amazing to me. There was 190 million shares outstanding in April of 2021. There's still 190 million shares outstanding. This is buying the dip here. People want to say, not trend investing. She's saying now, you've got to stick with me 4 or 5 years. But it's remarkable how loyal her following, down 60%. And still no outflows.
If you believe in her premise, if you believe in the game plan that she's got in place, and you could buy her for 60% off compared to a year ago, and you've got time. Again, I'm not going to talk about the age much anymore, but my kids are in their 20s. I keep telling them, push into Kathy Wood, because 5, 10, 20, 30, 40 years from now, not saying you and I don't have the time, but boy.
You keep pointing at me when you say old people and don't have the time.
You and I, come on.
Okay, sure. Not that I'm sensitive about this. MEB, Cambria, changing the subject, has several other funds for investors who want alternatives out there. You have a tail risk ETF. It holds cash and treasuries and put options. This is kind of an unusual choice, but tell us about this.
Yeah, so, you know, when we launch funds, we want funds, we say there's 10,000 funds out there. You guys talk about a lot of them. I always say, why do we need any more funds? And so we only launch funds that either don't exist or we think we can do much better, much cheaper. And better, obviously, subjective. But all of our funds are cheaper than the category average. And in this case, we've launched 2 tail risk funds. So there's tail and fail. The tail is the U.S., fail is the foreign. But we looked around the category and we said there's not a way to express this trade that we want to do that's out there currently. So we wrote a white paper. We then launched this fund, and the concept is simple. If you want to be able to hedge a part of your portfolio, how would you possibly design it? In the long history, and we did this white paper, when stocks do very poorly, you know, the more vernacular, when they barf, when they puke, when they really go down bad in a given day, a given month, or even a bear market, what helps? Well, all the things you expect not to help, like look at today, don't help historically. Foreign stocks don't help. Real estate doesn't help. Gold is like your crazy neighbor. Helps sometimes, maybe not. Commodities on average don't help. Bonds help sometimes, right? But the better part of the first part of the century, the 20th century, they didn't really help during the bad times. Everyone expects them to help today, but they may or may not. But on average, they've helped. And so what else has helped? Trend following has helped. But tail risk, you can't say guaranteed in our world, but is almost guaranteed to help by buying puts. Okay, so what we do in this fund, 90% hangs out in the 10-year treasury. And the rest we buy our ladder puts on the stock market. The goal is to try to, over a really bad day, month, bear market, get about a 1 to -1 exposure to U.S. stocks. And it's done a very good job of that. But the key for all these tail risk type of strategies is you look at them over time, they just kind of, it's like a life insurance policy, right? It just loses money,
right.
And then does well. So the trying to lose less money in the bad times, which is where a lot of the other funds struggle.
Well, that's the problem I have with this, Tom. It's a money loser over time. I mean, you've got cash and bonds. Cash is going to deteriorate, and bonds are already deteriorating, and they're buying puts to get a little to prevent you from losing too much over time. It's a tough argument.
Well, when you look at trend following, and you could put a 200-day average on this ETF, and over time, if you have an equity market that looks expensive, and bonds are flat, and the prospect for bonds are flat, this is a great way to hedge. And most people, You know, again, rather than going short or inverse in leverage, that I'm not going to get you started on that, Bob.
Please.
But it's one of those things where it's another option, it's another choice, and there's a lot of good education that goes in that.
Meb, you've got a more traditional yield ETF that I can understand a little easier, SYLD. It looks for stocks with attractive cash flows. Tell us a little bit about this. I have a board of what's in it, too. I'll get you to comment on that.
Yeah, you know, it's funny. You guys listeners probably are like, Meb's a perma bear or something, and that's not remotely true. You know, I just think right now, if you look at U.S. stocks, they're expensive, some of the most expensive they've ever been, and they're in a downtrend. And historically, that is produced about 0% returns. So on a valuation level alone, we're expecting 0 real returns on U.S. stocks for the next decade. That's market cap weighted, however. So what can you do within U.S. stocks? Our largest fund is this U.S. stock fund. And it's very Buffett-esque sort of strategy. It's looking for great companies that generate a lot of cash flow, that are trading for cheap valuations, and the CEOs are behaving by returning cash to shareholders through dividends or net buybacks. You can take this strategy back-tested back to the 1920s, and it outperforms basically almost any traditional value dividend strategy over time. It's a very sensible strategy. We run it in U.S., foreign, and emerging. They've all done well. But some of the characteristics right now, you can pull it up on Morningstar or CNBC, wherever, and look at the actual X-ray of the holdings. You know, value for a better part of my career when we launched ETFs in 2013 has been out of favor. You alluded to that in the beginning, that something changed in 2020, whether it was the election, interest rates bottoming near zero, or the pandemic bottom. You know, value had one of its worst years in history in 2019, and then following, I think it was 2020, 2021, it's really rebounded.
Right.
But if you look at the spread, like, it's barely even moved off the bottom. It hasn't condensed at all. And so I think you have this opportunity that could last for years. Yeah. You know, days like today, it may clear up by the end of the year.
Not,
I don't know.
The SYLD is not necessarily value stocks. I mean, I'm looking at these. It's attractive cash flows. I'm looking at top holdings: Dillard's, Nucor, Mosaic, Louisiana Pacific, Steel Dynamics. I don't know. I guess you would call them value. I don't know.
Yeah.
Nucor
Part of the screen is we use a value ensemble. So the very traditional value factors that Fama would love at the beginning. When we talk about value, all that really matters, it doesn't have to be that specific, is that are you using value at all? Because the opposite, everyone all loves to talk about value stocks and we love them, but it's not just that you're buying the cheap stuff, it's also that you're avoiding the really expensive. And let's be honest, the last 2 years, my God, some of the craziness we've seen in markets and some of these stocks, like 10 times revenue used to be the ceiling, it then became the floor in a lot of these stocks. And so you have both sides to it. You're hanging out on the cheap stuff, but it's also that you're avoiding the really expensive.
Before we let you go, just one quick thing. If you were to pick right now, where's the best value around the world?
This is unpopular. This is why value works, is because the U.S. is a long-term P ratio, CAPE ratio, Shiller about 32. It was 40 last year. Foreign developed, totally reasonable, around 20. Foreign emerging, this is my pick. Close your eyes, hold your nose, stinky opportunity, emerging value over the next decade. On a pure compounding basis, I think the place to really be. A lot of these countries are now in single-digit PE ratios. Historically, got everything going for them. Demographics, you got super cheap companies, and they get a kicker from a lot of the commodity trade as well.
And they have a tough time in a rising interest rate environment.
Really
emerging
tough.
market, really tough. Thank you for saying really tough. I felt like saying, yeah. But that's why we like Meb, because he comes on.
Yeah,
these
that's
are
why they're cheap.
Plays.
Yeah, that's it.
That is why they're cheap. All right, gentlemen, thank you. That does it for this week's ETF Edge. My thanks to Meb and Tom. We've asked Tom to stick around to talk about other ETF investing trends for the ETF Edge podcast. Remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.